Hello and welcome to the first part of a special two-part note in which we're going to be discussing two of the most critical questions facing any investor. Can it make sense to say that a market as a whole is overvalued or undervalued? And if so, how can we tell? It's the subject of a very fierce debate, a perennial debate. And with me now to discuss this is one of the main contributors to the discussion on this. He's the author of The Road to Recovery and perhaps more importantly a freshly minted new FT blogger, Andrew Smithers. Andrew, thanks very much for joining me today. Now, as we'll discover, a lot of the most important ideas on this come from Yale University, which is why we have that beautiful photo there. You've produced this fascinating concept called hindsight value to give us some kind of a clue when markets with hindsight were cheap and expensive. Can you take me through what the hindsight value concept means?
Yes. Well, first of all, I should tell you that the origin of this is Stephen Wright, my colleague, who I think it's a brilliant idea and it's not mine. The problem that you face if you're trying to work out how well markets were valued in the past is you can't simply take what return they had over a particular time period. Because the return from period A to period B varies as much because of the value at the end of B than it did because it started at A. So Stephen had the sound mathematical view, and he's a very good mathematician, of combining whole time series to get a single figure.
So we've got here a line produced on 10 years worth of data and another on 30
years. Well, once you get this idea, you have to make sure that you are getting as much information as possible, but it's reliable. So the first thing we did was to look at how reliable any particular time period was. And here you have an example. What we've done here, and perhaps I should explain in a little more detail of what's going on, is we've taken the return over the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years, the average, and similarly the average over 1 to 30. And we compared it to the average over the whole period. Now, returns, fortunately, we know from experience, are pretty stable over the long term. The US equities have given you something like 6 and a bit return for a couple of hundred years.
But there have been a few very key moments, such as 1929 and 1932,
absolutely,
when things
went awry. And the first thing we therefore looked was, you want, as I said, as much information as you can. So you want to have as fewer years, because if you have 30-year data, you only know what's going on up to 1983, i.e. 30 years ago. And if we could use 10 years data, we could do it up to 1993.
You've been solid enough to hold with the 30-year data here because that is what we can rely upon.
And as you see from this chart, if you compare 10 years with 30, there are some pretty odd differences. There are occasions, and I'm looking at the chart and thinking the late 30s and in the middle 40s, when the hindsight shows that the market was fairly reasonably valued,
and
whereas the 10-year data shows that they were seriously overvalued.
Now, talking of indicators that can lead you astray, now that we've got this concept of hindsight value, let's use that as the yardstick for various measures which stockbrokers will often use to tell us whether markets are cheap or expensive. There's dividend yields over time. So one thinks that a low dividend yield is a sign that markets are expensive and vice versa. This tends to suggest that it's not that reliable an indicator.
No, it's pretty poor, in fact. You can see that if we go back again, I think 1909, 1905, 1915, these things. 15, I think, is the one which shows the market was pretty fairly valued. But hindsight value tells you that it was extremely overpriced.
Okay, so dividend yields are not as useful as some people would tell you they are. Now let's take a look at the trailing historic price earnings ratio, possibly the single most cited measure of valuation. The figures there for 1920 and for 1932 could scarcely be more dramatic.
I know. This is clear nonsense. You can demonstrate it by simply saying it would be ridiculous to say that the market was expensive in 1932, which you would if you looked at trailing PEs.
Okay, but basically markets know that profits tend to be cyclical and take account of that in their PE, meaning it's
Exactly.
More or less useless. Now let's look at what back in the 90s was a very popular measure, which was often known as the Fed model, because Alan Greenspan himself seemed to be using it. This is comparing equity yields to bond yields. It has a period where it does appear to work very well, and another period where it seems to be totally useless.
This is, I think, one of the most disgraceful episodes in what we call data mining. There was a period when the two were tracking each other, and so there were a number of stockbrokers who went around selling this as the story. So when the market went up to extremely high levels, and it's beyond this chart, by the way, that you'll see a very good collection. You will see from 90, and I remember just purely from memory, from about 1985 to 1997, they've tracked each other beautifully. And it was used to
gently declining yields, gently rising share prices during that long period.
And rising earnings yields, falling earnings yields, rising PEs, and falling bond yields. And this was used to explain to people that the market, which was extremely overvalued at the end of this period, was not overvalued at all. It was, in my view, a quite disgraceful, the sort of thing that a self-respecting financial service industry should never do.
Okay, Andrew,
and you can see by looking at it for the previous 10, 15 years, where exactly the opposite relationship held. When you had bond yields rising from 54 to 85 or whatever it was, and earnings yields coming down, earnings yields going exactly in the opposite direction. And had people not data mining is using a particular set of data to establish your point, rather than using all the data that you've got available. Particularly if you use all the data, you end up by coming to the opposite conclusion.
Okay, Andrew, thank you very much indeed. So that concludes the first part, in which we've used hindsight value to, I think, very effectively trash a number of metrics of value that people out there will be trying to sell you. In the second part, we're going to move on to the perhaps rather more difficult task of finding some metrics which actually do work.